Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
What we will be hitting today is how you can become your own bank. Now, this concept has been around for 200 years, okay? This is not a new thing. This is not some magical new wealth building plan, get rich quick scheme. Not at all. This is a very long-term strategy of how you can replace the banks in your life and be the bank. If you guys were a bank, imagine, just say it's a crazy world. You guys were a Bank of America, let's just call it. You own and run the bank. Would you guys make deposits at your bank or somebody else's bank? Yes, sir, right there. Of course you go to your bank, right? What if you needed a loan? If you needed a loan for a car or a house or rehab on a rental property, where would you get that loan from? You'd borrow from yourself, right? And if you borrowed money from your bank, would you pay your bank back with principal and interest? Yes, you would, right? Because you wouldn't steal from yourself. You wouldn't steal from your business. Just like if you guys are business owners now or you have investments you guys run now, you don't steal from yourself. It doesn't make sense. So why don't every single one of you guys in here today have your own bank? The answer is simple. It's because you haven't learned how to yet. Yeah, 100%, guys. So this is a long, old concept, been around for 200 years. And you know what families have incorporated this strategy? Families you all know. The Rothschilds, sure you know that name. The Rockefellers, guarantee you know that name. How many of you guys know who the Rockefellers are? Bet every single one of you. Jay Bravo, how did you know? Disney's next. We got Ray Kroc. He started McDonald's. And we know Walt Disney. Thank you for spoiling it a little bit. Yes, of course Disney did this strategy. When he was dead broke in the Great Depression, how did he build a multi-billion-dollar business? Not that he lived to see it be that big, but through this strategy. He actually took a loan from his own bank to buy the land for Disneyland. How crazy is that? That's not talked about. To keep the business afloat, he pulled from his own bank. Eventually, he paid his bank back. But how cool is that? He did this, so can you. And as of recently, if you guys are football fans, you guys know Mr. Jim Harbaugh. Jim Harbaugh did this exact same thing. When he got his last contract with the University of Michigan, a big contract, multi-million-dollar deal, most of his paycheck actually went to his bank, not somebody else's. He forced it into his financial plan so that he is not just wealthy, but his family will be set up for life. Really, really cool. I've been doing this for a few years, and over the past few years, I've met with over 3,000 families actually. So a lot of people, 3,000 families across the country, teaching them this wealth building concept. And it's allowed Anna and I to do some pretty cool stuff. We've traveled the world with some of these companies we work with. We buy a lot of real estate. That's what I mainly spend my time doing. And it's really helped us build the perfect foundation to not just be rich, but to build foundational and really generational wealth. And so today, what I want to talk about is the decision that I made. The decision I made was to actually get out of the rat race, drop out of school and pursue an education in investing, learning how to make money work for me. And that completely changed the course of my life. You guys can incorporate that same idea. You don't have to quit your job or stop doing whatever you're doing, but mindset wise, get out of that traditional world, get into this new world, and find a way to build a system, a private system to finance your lifestyle through. And so when I was studying money, learning about all these different ideas and educating myself on investing, a question came up. Could it be possible that there are more efficient environments to store wealth outside of commercial banks that you are not aware of? This system becomes an ever or a never-ending journey of financial education. There's always something new to learn. And so when I pose this question, guys, stop and think about it. Yes, there's more efficient places. This is powerful because I want you guys to start thinking about what you're not already thinking about, what you haven't yet been taught to think about. And I hope when it comes to money, you can have kind of a learner, humble learning mentality throughout your life. But in these different money books that we all read, Tony Robbins' book, Money Master the Game, Robert Kiyosaki, Rich Dad, Poor Dad, Richest Man in Babylon, these main basic financial books, what does everyone teach? Everyone says you need to be saving money. If you can't save money, you're never going to build anything. And most people, even the Bible, says you should save at least 10% of your income. 10%. Most people in America save way less than that. And I think the reason is that people in America don't value savings. Really the world. No one values the retention of our dollars and our control. Now, what does that mean? I think the reason people don't actually care about the control of our money is because the environments we're told to put our money, they're so inefficient. They're inefficient that it makes it hard for us to want to save money. These places that we put money are like, example, high yield savings accounts, CDs, 401ks. They're inefficient. They're not actually building you wealth, but they're building others, the bank's wealth. So what we're going to talk about today is banking. Banking is a major, aspect of your lives. Every single one of you do banking somehow with someone. So it's not like something you can avoid doing. Everyone in America should be doing this because everyone banks. So what is banking? Banking in the noun form is just the business of protecting money, which I think is funny. That's what Google says. The business of protecting money. Who protects your money best? You or some big institution, right? They don't care about your money. If you have $1,000 in the account, they don't care, right? So you should be in the business of protecting money, not somebody else, especially if it's your hard working money you spent all your time and life trying to build. So what's the verb of banking? What's the act of actually doing it? Well, it's actively protecting money, it's actively depositing money, and it's lending money. So it's the movement of money that we're all doing. And this affects every single component of your life. So wouldn't it be smart to start actually knowing how this applies in our life and learning about it, right? So once you guys see the banking world the way it really is, it's going to change everything for you. So let's show you what the bank is. Obviously, what is your bank that we're going to set up? I've been teasing it a little bit. What is your bank? I'm going to tease it a little bit more. I'm going to compare the attributes of what your bank will be, what you wish your bank could be. And I'm going to compare it to a traditional bank, just like a savings account, right? Well, guess what? They're liquid. What is the main attribute of a bank? It's liquid. That's what a bank is, right? It's just liquid. So if we need liquidity, then we got to make sure your bank's liquid, right? So if it's liquid, then what? Well, what if it grew? The average savings account today grows at 0.07%. That's with some of the high yield accounts that we have today. What if your bank grew 2, 5, 6, 7%? What if it was guaranteed? What if it was uninterrupted compounding interest? Big words, powerful words. What if it was also tax-free? Your bank's taxed. Wherever you have, sorry, not your bank, your current bank, your traditional bank is taxed. Any income you have, the 2 cents you make on the year, taxed. What if your bank was compounding interest tax-free? Crazy, right? What if it was protected from lawsuits, judgments, liens? That would be pretty awesome too, right? If they were completely safe. What if they were stable too? What if the bank you set up was stable, no matter the economic time, no matter the recession or the boom or the bust, whatever it is, who cares? It was always stable. Guys, in 2009, 364 banks went bankrupt. My bank didn't. Chris Naugle's bank didn't. Those of you who are on here already have your bank set up. They weren't bankrupt. They actually made money those years. Guaranteed. Powerful, powerful stuff. So why wouldn't this, well, not why. Now that you see this, Wouldn't this be the most efficient place for you to store money? Wouldn't this be a place you could count on, you could control, you could use as a foundation to finance everything throughout your life? Guys, life's crazy. So the opportunity that this would actually give you, the peace of mind at night, the opportunity to put money somewhere that's guaranteed to grow, compounding interest, tax-free, risk-free from the market, no downside. And to add to the list, what if your funds were all available and liquid for you to use and pull out? And if you did pull money out, it actually wouldn't stop your bank from growing because you were the bank. You were growing anytime. That would be pretty dang sweet, right? So let's get into what your bank actually is. I've teased you guys enough. The vehicle we use, before I tell you what it is again, I want to share this quote with you guys by Mr. Will Rogers, who says, "The problem in America isn't so much what people don't know, it's what people think they know. That just ain't so." Guys, this is the problem we have as well. We think we know what's going on in America. We think we know what's happening with our money. We don't. That's the problem. And we're too stubborn to realize it, or too arrogant or complacent. Let's get rid of those feelings in our life and let's take ownership. Let's be good stewards over our money. And so the place we're going to run our money through is this vehicle. Again, we're not going to use this vehicle as just a one-stop shop, but as a banking vehicle to protect our money, to deposit money, to lend money, to be moving money through our system. Right now, you use Wall Street to do that. Let's change that to our bank. And your bank is a dividend-paying whole life insurance policy from a mutual company. Now, don't run away because you hear life insurance. Guys, this is not regular life insurance. This is not the Dave Ramsey kind of life insurance you hear about. Not at all. This is specially designed and engineered whole life. And you only can do banking with whole life. And a lot of people have questions about this because they're like, oh, Dave Ramsey says buy a term and invest the difference, right? We have math to prove to you that's a horrible idea. We have a whole white paper written up with very smart economists and PhD insurance people teaching that that's actually not the most efficient idea. So there is a much better way to be storing money, using money, spending money, and it actually is through a specially designed whole life. And I'll agree with those naysayers. If you are expecting a regular whole life policy to do what I'm about to show you, I'd be really upset because it's not going to do that. It needs to be specially designed. And I call it, or I don't call it, I look at it kind of like this analogy here. If you guys ever went to a car dealership and saw this little car in the driveway, it's a Ford Focus. You're probably thinking, oh, that's a fine car, right? Whatever. It's a good looking, easy car. Nothing crazy. Well, if you guys were to go on YouTube and look up Ken Block, you will see Ken Block going 130 miles an hour, drifting around a turn in this Ford Focus. So what is the difference between that first one and this one? The design and engineering of the vehicle. These specially designed policies are the exact same way. It looks nothing like regular life insurance. It actually looks more like a supercharged bank account than anything else. Pretty cool stuff. And now, many of you might not still be believing this because you might have heard life insurance is, whatever. Some people say life insurance is got a low rate of return. It's expensive. It's the worst investment of all time, I've even heard. If you guys are writing notes today, please write this next piece down. Just take this away. Guys, whole life insurance is not an investment. It's not. It has nothing to do with investing or investments. It's actually considered an alternative asset class, and it's a type of permanent insurance. If you read the contract, everything's guaranteed. It's guaranteed to grow forever. There's no risk, no volatility. That's not an investment. Investments require risk. So if you could take anything from today, take this. It's not an investment. And when you guys go home and talk to your neighbors, your business partners, your spouse, your broke brother-in-law who sells insurance, when they start telling you it's a terrible investment, don't do this, it's got a low rate of return, you now know as soon as someone says that, they have no idea what on earth they're talking about because they can't even correctly identify what type of asset that whole life is. Get the facts from people who actually are successful and know what they're doing. Guys, you cannot get a policy built like this, even from your traditional insurance agent, from your financial advisor, from your CPA. They won't know how to build a policy like this. You have to get a policy like this from a banking professional, someone who teaches, lives, breathes banking. That's very hard to find. There's very few people in the country that can do that. That's what we are as a banking professional, firm. We're a firm that teaches this strategy, and this is what we specialize in. This is our niche. And so again, if you want to be the bank, mimic what banks do. And when you want to learn this strategy really in depth, I'd go buy this book. It's called Becoming Your Own Banker by Nelson Nash. Every single one of you should buy this book. Fantastic book. And in this book, he says that the problem is you finance everything in life. Okay, so why is that a problem? Why is financing everything in life a problem? Well, it means that you're either going to borrow money and pay interest to somebody, or you're going to save up money and then spend it cash and buy something. That way there's still an interest cost. Maybe you don't pay interest on the purchase, but you just gave up money that now has an interest cost because it's never going to earn interest again. That's an opportunity cost of interest you could have earned. That's still an interest cost. If you, and I guess too, the problem is that you finance all of these things through other banking organizations. The problem is that all of these items in our life are financed through other banking organizations. We've been taught to get into business with or investing with the bankers, but the bankers are in control of all of the flow of money. Whether we pay cash or we finance, it doesn't matter. They're at the core of it, collecting, controlling, and making insane profits off of all the hard work we're doing. So why don't we just become the bank? We take control of these transactions, so we're the one always earning interest. And guys, it's not just us who does this. Banks do this too. Of course they do, right? That's why we're going to be the bank. Look up BOLI, bank-owned life insurance. It's very common. What you will find is that banks own more whole life insurance than they own in land and buildings combined. Guys, you know how many land and buildings these banks have everywhere in the world, every block. They have more whole life than all of those buildings combined. Absolutely insane, right? And guess what? They're not buying IULs. They're not buying VULs. They're not buying term insurance. They're buying whole life specifically. They're the number one purchasers of these specially designed whole life policies in the world, actually. And not only do they own a lot, they buy more every single year. So you need to ask yourself, are banks stupid or do they just know something that you don't know? Guys, these four banks alone are worth over $60 billion. That's a massive number. They're not stupid. They know exactly what they're doing. They're smarter than you are, smarter than I am. We just need to mimic what they're doing. What do banks do? I will show you a chart here, how the money moves. If you were to go deposit money with a bank, call it 100 grand just for the easy number. You can call it 10 grand, 100 bucks, whatever you want. But if you deposited money with a bank, what do they do immediately? Guys in the chat, let me know. They're going to lend it to somebody who wants a house. Call it a 7% loan on a house. When that person closes on the house, guess what the seller does? Where do they put their money? They don't take cash and put it in their pocket. They put it back in the bank. Who's going to lend it to somebody else? Probably on a car note at 8% in today's market. Who's going to pay a car dealership? And where's the car dealership putting money? They got a bank account too. Who's probably going to lend it to someone doing a home remodel who's going to pay a contractor who's going to put the money right back in. We're just playing tag, guys. Money goes in, out, out, tag, you're it, tag, you're it. Money's moving around in the same place. Let's just throw one more debt in there just for the sake of it. Guys, who's in control of all of this? Obviously, you see it's the bank. Well, you're making 4%, they're making 7%. They're making a 3% spread. While you're making 4%, they're making 8%. They're making another 4% spread. Well, they're making 4%, they're making a 9% spread. Sorry, 5%, and then 8%. You add all of those spreads together. Guess what? Yes, they're making 20% more, but you're making 4%. So if they're making 4% and they're making 20%, they will be making 500% more money on your cash sitting in the bank every single year. Put that number into perspective. 500% annually. Guys, you go to BauerFinancial.com, you will read that banks make between 400 and 1300% every single year on your money. Not less than 400%. Insane. So earlier when I told you guys that these banks are not stupid, they're very smart, and they're the number one purchasers of these insurance policies in the world, what were you thinking? No, that doesn't make sense. Guys, they're smart. They know exactly what they're doing. We just need to mimic them. What else do banks do? They understand compounding interest. I'm going to share an analogy with you guys here and some numbers, and then we're going to get into some real life examples of how this works, and then we're going to wrap up with Q&A. Here's the analogy. If you had $1 million today, okay, just today, $1 million in the pocket, or I gave you a penny, but that penny doubled every single day for 30 days, what would you guys choose? This is the math. You have a penny on day 1, 2 on day 2, 4 on day 3, 8, 16, 32, 64, $1.28. By day 15, you're only at $160. Might be a little shaken in your boots, right? Day 16, it's up to $300. Grows from there. By day 30, it's at 5.3 million. Absolutely a ridiculous number. That penny would grow to 5.3. If it was July, a 31-day month, it'd be $10 million. Guys, it's insane. Compounding interest is so powerful. Like Einstein said, it's the 8th wonder of the world. So let's keep this example going, but let's just say there was a fee attached. Just for the sake of it, let's say there's a 2% fee attached to your penny compounding. 2% against the dollar or the penny compounding every day, the money only grows to 2.9. Guys, you will know places that you can put money that have a 2% charge. a broker's account, a money market account, probably a high yield account, any money managed account, there's probably a fee, 1 to 3%. That 2% fee just eliminated over $2 million of compounding. It was going to be 5.3, now it's 2.9. That is a massive drop because of a 2% fee. 2% of 5.3 million is not this number. You guys lost way more. So the compounding against you is also pretty hefty. We don't want that. We don't want a place to put money that has that compounding against us. And we're always told, hey, what if you wanted to withdraw money from your account? You can. Let's say you withdrew $100 from the penny compounding on the 15th day and $100 on the 25th day. Only freaking grows to $2 million. $2 million. You miss out on $3 million of compounding because of a stupid $200 withdrawal. Whoever told you to withdraw $200 is stupid. 2.08 million. It could have been 5.3. If you just took a loan for $200, who cares what the interest would have been? You'd have compounded way more. Another example, what if you had a tax, a 15% tax against your money compounding? You only would grow to 500 grand. And how many of you guys would agree that some of the places we've been taught to put money have all three of those things going on with them? There's a small fee for somebody managing it. There's a tax that's always there. And well, if you need to tap into it, go ahead, take money out. And we wonder why Americans can't get ahead. We wonder why we can't grow. It's because we're put our money in places that have all these three things going against you. And guess what type of account would have none of these things? No 2% management fee, no tax, no withdrawal, specially designed whole life insurance, guys. Your dollars always sit in compound interest. And your policy, if that penny went into a policy, it would have compounded to 5.3 million. And if you needed to withdraw $200, you could have taken a loan for $200 from your policy, and the policy would have still kept growing. Absolutely genius if you could have had that system set up instead. Guys, now that we've kind of laid the framework of the power of whole life, the credibility behind whole life, what banks do and how they operate, why you'd want to do this, and now the compounding interest. Let's go put this into action. Let's give you guys a real life example. I'm going to show you guys an example of how you can actually buy a car through a policy. This is an example of a policy. A lot of numbers, a lot of charts. Don't look at it yet. I'm going to go in deep into it in like 2 minutes. So just wait and hold off. Most people, when they look at a premium for anything, home insurance, health insurance, car insurance, life insurance, they look at it as an expense, as a payment, as a bill. No one wants those things, right? Well, you also are probably someone who wants to save as much money as possible in a savings account, and no one's scared of putting more and more money in your savings account. Why? Well, because it's liquid. It's yours, kind of. It's not really yours, it's the bank's, but it's kind of yours. So what if your policy, your bank, was all still liquid? Then you would look at it as a deposit. You would want to deposit as much money as humanly possible inside of the policy, right? So don't look at a premium as an expense, but now as a deposit. And what about age? What about death benefit? A lot of people always say, oh, I'm too old to do this, or oh, I'm too young to do this. No, does not matter your age. If I put $1 in a policy or my grandma puts $1 in her policy, it's still $1. You still have access to $1. If we both have a bank account at Wells Fargo, because she's older, she's not penalized, it's still $1. So the policy's the same way. Yes, the death benefit might be different the older you are, but if we're not building this policy for a death benefit, we're building it to do banking, then who cares what the coverage is? The death benefit is just a cherry on top of having this whole system. So the older you are, yes, it's a smaller death benefit, but again, you weren't doing this for the death benefit anyways. And as well, you might be thinking, oh, you have to be rich to do this. Not at all. The person in the example I'm going to share with you is someone who just saved 10% of their income. They had a good income. They made 100 grand a year, which nowadays I feel like is pretty common. They saved 10 grand a year, 10%. Not a crazy number. They did not need to have millions of dollars in the bank to do this. So let's look at this example. This individual, again, was saving $10,000 a year. So 10 grand a year was going into their policy. The cash value on the policy is what they have access to use. That's the leverage inside of the policy that's liquid and available for them. So let's just say they took $25,000 out of this policy and they went and bought a car. Okay, they put 30K into the policy over 3 years. They take 25 out and they go buy a car. This is where the numbers get a little bit complex, so please follow me if you can. Ask questions if you need me to clarify things. 25, go buy a car. Well, if you take a $25,000 loan from yourself, well, you got to pay yourself back, right? So let's repay ourselves $500 a month for 60 months, just like any other car note would have been. And remember, you're earning compound interest inside of this policy while you're doing all of this. So that's why you'll see the policy grows. But look, after 7 years, you put in 70K in premiums. You've paid in 30K to repay your loans, and you've also taken 25 out. So really your net injection into this policy is 75K. You put 75 grand into this policy and you got a car in the driveway fully paid off. Okay? Look at the cash value after 7 years. The cash value is 67,000. And what is 67,000 of the 75 you put in? 91%. So you have access to 91% of the money you put into the policy, and you have a car. Think about the alternative route. You would have saved 100 grand in a bank account, took out 25 to buy a car cash, and lost 25 grand. In this scenario, you have basically all your money still there, and you got a car, and all of your money is still growing the full amount. Okay, let's look at year number 8. Let's keep the example going just to make it easier for you guys to see another scenario. Let's say if you stopped paying premiums in the 8th year and no more deposits into it, but you took another 25K loan and your policy kept growing, and then you paid your policy back $500 a month for 60 months, just like any other car note. So you've paid in 0 in premiums, 30 in repayments. You've taken out 25 to buy the car. So you've put into this puppy 5 grand. You've put in 5 grand and look at the growth in the policy. It went from 67 to 91. So your policy grew $23,000 and you put in 5. Now that's powerful. You put in 5 grand, you bought a car and made 23. Again, because your policy is compounding while you use the funds and pay yourself back with interest. Guys, those are kind of the rules we want to follow when banking with ourselves. We want to pay ourselves first. So 10 grand a year, he put aside and paid himself and put it into his policy instead of paying somebody else. He then paid himself back with interest on his loan, and he recycled and recaptured that money. Because wouldn't it make sense to pay yourself interest compared to somebody else? Right? Heck yeah, it would. If this works for a car, then guys, what else does it work for? Absolutely everything. Isn't this amazing, guys? Don't you wish you knew this earlier in your life? Don't you wish you did this the last time you bought a car? Are you guys going to do this the next time you buy a car? How about the next house, the next tax bill, the next tuition cost for a child or grandchild, the next car? Guys, everything. Let's just say you had a debt you wanted to pay off. Here's an example of how the money actually moves. Instead of having a car to purchase, you actually have a debt to pay off. Let's say you have a $23,000 line of credit at 9%, and you're paying somebody else that. Let's just change one thing before you pay off the debt. Let's say you have the money sitting in a bank, you could pay off the debt today. Well, instead of giving the money to the bank and losing that money, put it through your policy first. So now it sits in the policy and grows the rest of your life. So let's just say you put some money in the policy. Let's say you put in 30 grand. Maybe it's been over the past few years. Maybe it was all one time as a lump sum. So you've put 30K into the policy, and then you've taken 23 out as a loan, paid off your line of credit, which was 9%, and it was like $300 a month. What are you now going to do when you repay yourself? Repay yourself what you were paying the bank. If it was $289 a month, pay yourself back $289 a month. Not that hard. And then recapture that interest into the policy. So if you're a little confused at this point, what do you want to be better explained? The example of the car or the money movement in this scenario? But the money is just moving through your own system. It's flowing through your policy. You're paying off debt, refinancing someone else's debt, and then repaying yourself. You are just now the banker. What if this was an investment instead of a debt? What if you were earning 12% instead of paying somebody interest? If you were earning 12% on an investment, call it private money club, PMC, or this community we have to invest. If you were earning 12% in an investment, you could use the income from the investment to just refill the policy. If the policy then refills, take it out and go lend it to somebody else. Go make another investment. To wrap up, only one of two things are going to happen to us in our life. One, we're going to live. And man, aren't we better with this than without this in our life? I just showed you multiple examples of how that's true. What if tragically something happened to you? Is your family better off with this or without? With, because yes, there is a death benefit, so they're going to get a multiple sent to them of whatever you have in the policy. If you just had money sitting in a bank account, that's all they would get. So yes, you are setting not just yourself up, but your family up for future success. Don't you guys wish you learned this when you were my age? Or don't you wish you learned this or could teach this to your young adults, your kids? Don't you wish your parents started a bank for you when you were younger? Guys, thus far we've talked about how banks profit by leveraging your money. We've talked about how you don't need to be rich to do this. You just need the right tools in place. And with inflation and market uncertainty, this concept of family banking gives you total control. Guys, if you want to have certainty and control over your money throughout your life from here on out, then you absolutely need to set up a banking policy. The way to set this up is extremely easy. Our company is designed to teach this strategy. We will work with you and show you how to set it up best for you, what makes most sense for your numbers, what your cash flow looks like, what your investments would look like through this, and show you the real scenario of what you can do with this. Now, we are paid from insurance companies for the business that we bring them. So there is no cost or fees for you. You are literally just setting up and using a policy, and we're here to help you do that. If you guys want to set up a one-on-one meeting, again, everything is free to do this. We're just here to help you understand how you can incorporate it yourself. We have the relationships with the right insurance companies, with the right policies. We can show you how to do this. Please set up time to meet with me. You can schedule time at carson.beyourownbanker.com. I threw the link in the chat as well. All of you are awesome. Thanks for being here. Every Tuesday we do this presentation. Every other day we do a new presentation teaching different ideas. Let us know what you want to hear from us. Let us know what questions you have and want to learn. And we'll see you on the next one. And have a good day. Thank you.